Ever wonder why the wealthy stay calm when markets crash? Why they don't panic during inflation, recessions, or geopolitical turmoil? It's not because they're lucky, it's because they hedge. While most people are worried about rising grocery prices, shrinking savings, or volatile investments, the rich are busy protecting what they already have. And they use a financial strategy that's barely understood by the average person. Hedging. In this video, we're going to unpack what hedging really is, why it's so powerful, and how even you can start thinking like the wealthy when it comes to protecting your money. In simple terms, hedging is like financial insurance. It doesn't eliminate risk entirely, but it reduces potential losses. It's a strategy used by both corporations and individuals to manage risk and avoid severe financial consequences. Think of it this way. When you buy car insurance, you're not hoping to crash. You're protecting yourself if it happens. Hedging works the same way for your investments. It prepares you for the worst, so you're not wiped out if something goes wrong. Wealthy people don't just aim to grow their money. They obsess over not losing it. So they hedge against anything that could hurt their portfolio. Market crashes, inflation, currency swings, even commodity prices. This mindset shift is key. Most people play offense. The rich also play defense. And the more money you have, the more critical it becomes to protect it. One bad market move can undo years of growth, unless you're hedged. And hedging isn't just for billionaires. Companies do it all the time. In fact, you've probably interacted with hedging strategies without even realizing it. Let me give you some real-life examples. Take Starbucks. Yes, the coffee giant. Did you know they hedge against the price of coffee beans? They lock in prices in advance, so if the global market price of coffee spikes, it doesn't wreck their profit margins. This helps them keep your cup of coffee at a predictable price. Airlines do something similar. They hedge against oil prices. Fuel is one of their biggest expenses, so they use contracts to lock in prices ahead of time. That way, if oil prices skyrocket, they won't suddenly go bankrupt trying to fuel their planes. Even farmers hedge. They pre-sell their crops at set prices to avoid losses if market prices fall during harvest season. It gives them stability and helps them secure loans. Hedge funds? Their name comes from this very concept. Originally, hedge funds were created to hedge against market losses by balancing risk across different investments. For instance, buying one stock while shorting another. Closer to home, locking in a fixed mortgage rate is a form of hedging. So is buying a fixed-rate electricity plan to avoid seasonal price hikes. These are everyday examples of how people hedge without realizing it. The takeaway? Hedging isn't gambling. It's about being prepared, not paranoid. Now let's dive into how the wealthy use hedging like a financial superpower. They hedge against inflation by buying assets that rise in value when currency loses power, like gold, real estate, or stocks. They hold foreign currency accounts to protect themselves from domestic currency drops. For example, if the US dollar weakens, their euros or yen retain their value. They use complex tools like options. A put option, for example, allows them to sell a stock at a predetermined price, even if the stock crashes, limiting losses. They diversify in layers. If stocks fall, maybe bonds or real estate rise. If the US market drops, maybe emerging markets rise. It's like a financial shock absorber. They even hedge taxes. Wealthy families use vehicles like Roth IRAs, tax-exempt bonds, and charitable trusts to minimize tax liabilities, preserving wealth across generations. They also hedge time. They spread their investments across different timelines: short-term liquid funds, mid-term investments, and long-term plays. This reduces the pressure of needing everything to perform now. Here's the critical mindset. The average person asks, "How much can I make?" The rich ask, "How much can I lose? And how do I avoid that?" That difference changes everything. Can you hedge too? Absolutely. And you don't need to be rich to do it. Here are practical ways to hedge in your everyday life. 1. Diversify your income. Don't rely on just one job. Freelance, start a side hustle, or build passive income streams. If one fails, the others support you. 2. Buy inflation-resistant assets. Stocks, real estate, even collectibles like watches or art tend to hold value better than cash. 3. Keep an emergency fund. 3 to 6 months of expenses set aside means you're protected if life throws a curveball. 4. Use fixed-rate debt. Lock in your mortgage or loan rates when interest rates are low. It protects you from future hikes. 5. Invest in index funds. They're naturally diversified, reducing the impact of individual stock volatility. 6. Build your skills. Upskilling is a hedge against job market changes. The more versatile you are, the harder it is for a downturn to hurt you. 7. Insure your health. Your body is your most valuable asset. Health insurance, life insurance, even disability insurance are all personal hedges. 8. Plan your taxes. Use retirement accounts, tax deductions, and credits to hedge against high future tax rates. 9. Protect your digital life. Use password managers, backup data, and two-factor authentication. In a world of cyber threats, digital hedging matters too. You don't need to overcomplicate it. Hedging is really about one thing: controlling risk before it controls you. Let's face it, most people don't hedge. Why? Because we're wired for reward, not protection. We're trained to chase gains, not avoid losses. The media doesn't glamorize caution. You'll see headlines about people who made $1 million overnight, but never about the ones who lost everything because they didn't hedge. Many people believe hedging is too complicated. But the truth is, it's just about preparation. Would you drive without a seatbelt because crashes are rare? No. Then why treat your finances with less caution? The rich stay rich because they manage risk as much as reward. They don't assume the best. They prepare for the worst and win regardless. So don't just hope things go right. Build a system for when they go wrong. The rich don't just build wealth. They protect it. They prepare for the storm before the clouds appear. Hedging isn't exciting. It doesn't go viral. But it works. And it's one of the biggest reasons why wealth stays in wealthy families. So next time someone brags about doubling their money overnight, ask them what they'd do if it vanished just as fast. Because in the long game of wealth, those who survive the storm win the race. And hedging? That's your umbrella. If this video helped you see money differently, hit like, subscribe, and share it with someone who needs a hedge in their life. And in the comments, tell us, what's your favorite way to protect your finances? Let's build smarter habits together.